Pillow talks taxes. He has been for over 45 years, and there isn't a human on the planet with more experience solving problems on behalf of taxpayers. He wants to solve your problem whether you know you have one or not. So if you do have a tax problem, get a hold of him, call his office, visit his website. If you don't have a tax problem, your current tax problem is taxes themselves. So let's get into the policy issues of today, which the main one being the big, beautiful bill has passed the House. It's passed the Senate. It has now been signed by the president. Each different step had a different version of the bill. So now what are we left with?
We're left with the final version, Josh. We're left with the version that survived 30 different roll call votes in the House of Representatives. The Senate tweaked some things, dropped some things, massaged a lot of it, and it had to go back to the House of Representatives for their approval, which they did. July 1st is when the Senate voted on it, and the House voted on it on July 3rd to adopt all the Senate changes. The president signed it the next day, July the 4th, on the self-imposed deadline. We've got this massive piece of legislation now. I think there's about 14 or 15 different titles to the bill. There's only one of those sections that applies to taxes, broken down into business components and individual components. I just completed a very detailed analysis of the individual components of the bill. I'll have an article coming out on National Review and in my own newsletter, Pillow Talks, on the individual elements. I am working on the companion article, which will be the business elements of the bill as well. So I'm going to lay all of this stuff out. Now, some of this stuff we talked about, some of it we didn't talk about. We've got a law now, Josh. We've got a law that makes the Tax Cuts and Jobs Act permanent. This looming January 1st, December 31st, 2025 deadline of the Tax Cuts and Jobs Act expiring has been defeated. The largest components have been made permanent. I mean, what permanent means with tax legislation, because it really doesn't mean that much.
Well, that was a very politician answer that skirted around my actual question, which is what version of the bill did we actually get signed? Each step of the way, the House signed a bill, the Senate signed a bill. Those were two different bills. They had to come together to create something, the compromise bill.
You're exactly right. We haven't talked about the final compromise bill. But in answer to your question, there's a House version, there's a Senate version. And the Senate version then went back to the House of Representatives to be adopted. Ultimately, it was the Senate version of the bill that got adopted. It took 30 roll call votes in the House to get that done. The president's big three concerns, income, overtime pay, and Social Security benefits, are all addressed in the Senate bill. There's additional provisions for the tax rates, for example, that were provided for in the House bill. They survived the Senate bill. The tax rates are now the same as they were under the Tax Cuts and Jobs Act. There's an additional standard deduction that came out as far as the Social Security benefit is concerned. There's not an exemption from Social Security tax. That was not in the House bill. It was not in the Senate bill. It's obviously not in the final bill. Social Security taxes are not uniformly exempt, but there is a provision in the law that deals with Social Security. We got an additional deduction for automobile insurance. We got an additional deduction for charitable contributions. We can go through and talk about some of these things specifically if you want to as we go down the list.
But let me go ahead and reel back and bite the hook you set earlier that says, what exactly do you mean when you say they are made permanent?
The bottom line is this stuff means nothing. Some of the main provisions of the bill, the tip income, the overtime pay, and the limitation on taxability of Social Security benefits, those are all temporary under the bill. They only apply for tax years 2025 through 2028. So they're by definition temporary. And some of these other provisions are temporary as well. But here's the thing, Josh, even to the extent that this stuff is considered permanent, like the doubling of the standard deduction, what the Tax Cuts and Jobs Act did is it eliminated most, not all, but most of the itemized deductions available to taxpayers in favor of a standard deduction went from about $6,500 to $12,000 for individuals and from about $12,000 to $24,000 for married filing jointly. Now, with inflation adjustments, the deduction for married filing jointly is over $31,000. That's now called permanent. But every 2 years we have a new Congress. Whatever the power structures in Congress at that time will dictate whether they attack this particular provision or that particular provision. Trump is the president of the United States for the next 3.5 years. So it is unlikely that even if the Republicans lose control of the House and the Senate in the midterm elections, Trump will still be president and will very likely veto any substantive changes to the big, beautiful bill that were just structured here. But who's going to be president after Trump? Who's going to be president in 2028? We don't know. If the power structure completely changes, none of this stuff is permanent. All of the stuff is back on the chopping block again, including increased tax rates and more more taxes and less benefits. So the bottom line, Josh, is none of this stuff is permanent. Here's a fundamental problem I have with the poor structure of the tax system. I wrote a paper called The 10 Principles of Federal Tax Policy that was published by the Heartland Institute. That paper is available on my website, TaxHelpOnline.com. Go to special reports and look for the paper called The 10 Principles of Federal Tax Policy. One of my 10 principles that a sound tax system must encompass is the principle of stability. Taxpayers must have the right to know what the law requires of them and to plan their lives and businesses in accordance with the language of the law. Well, we got two problems with that. Number one, there's no plain language in the law. Number two, there's no stability. The tax code changes constantly. No matter who happens to be in power, they're going to shift this, change that, amend this, delete that, add that. All of this stuff goes on constantly. This is why we've had more than 6,000 changes to the Internal Revenue Code just since 2001 alone, right? So the last 25 years, more than 6,000 changes. Doesn't even count what's happened here in the last 4 or 5 years now with all the COVID changes, and now with the big beautiful bill, there's hundreds of additional changes now in that. That doesn't even take those into consideration. This is not a stable tax system. People do not have the ability to plan from year to year what their financial picture is going to look like. Businesses don't have the capacity to plan long term for their obligations and investments and growth, equipment, and manpower because they don't know what the tax laws are going to be. Every decision in life has tax consequences. Whether you get married or divorced, have kids, or a child leaves the house, buy a house and sell a house, start investing for retirement, or you start drawing retirement, whether you've got medical expenses or no medical expenses, just go down the list of all the most important affairs that happens in the life of an individual. Every single one of these things have tax consequences, Josh, and people should have the right to know that whatever the law is today, that's what the law is going to be tomorrow. Our system is so unstable that people cannot do that. There's no way that individuals and businesses can do that. And that to me is immoral. And I would argue that it's unconstitutional as a violation of the Due Process Clause.
You mentioned that we don't necessarily know what's going to happen with the next Congress because they can always just change whatever laws they put forward. If you asked me 2 months ago, I would have told you there was never going to be another Democrat Congress, another Democrat president with the political climate. But now with Trump adding $4 trillion to the deficit and basically being a Democrat himself, how he's been operating, I'm wondering if Republicans are going to have a problem in the next election.
Americans have a very short memory when it comes to elections. George W. Bush Sr., the first Gulf War was over. George H.W. Bush had about a 93% approval rating by the American voters. The next presidential election, less than 18 months later, he lost the election to Bill Clinton. So yeah, Americans have a short memory when it comes to what presidents and what Congresses do. That's a fact of life. The economy controls what voters do at the ballot box almost universally. If this big, beautiful bill has the effect of stimulating business, like I think it will have a very positive effect because of the tax rates that are lower and the additional business benefits that are in the bill. I think this is going to spur investment. I think it's going to spur hiring, and I think it's going to spur production. There's no doubt about that. The economy does react very favorably to this. I believe the Republicans will have a very good showing in the midterms. Now, what's going to happen 2 years after that? Who knows? One thing is for sure. You mentioned the $4 trillion of additional debt.
What is this bill going to do? The debt issue is not something that can just keep getting kicked down the road. One of the main things he ran on was eliminating government spending, waste, fraud, and duplication. On tweeted, what was the point of Doge if you're just going to add $4 more trillion worth of debt?
The answer is there is no point to Doge if they're just going to add $4 trillion to debt. Let's understand what the $4 trillion is. The $4 trillion is an increase in the debt ceiling, all right? I'm not saying they're not going to run up the debt on the credit card. I'm not naive here.
Already have that money allocated, I promise you.
There's very few people handed a credit card that somebody else has to pay for and they don't run it up to the max. The Congressional Budget Office scoring on the bill shows about 2.5 or so. The numbers vary depending on who you're reading, but if you look at the actual CBO estimate, it's about $2.4 trillion of additional deficit over the next 10 years based on the projections on this bill. What the White House is arguing is that those are static projections. They don't take into account individual behavior. It is a fact of life that when you increase tax rates, you reduce the production of revenue into those tax brackets because people don't want to work for less money. The proof of it is this. If we had a tax bracket of 100%, how much revenue would be generated in that 100% bracket?
Zero.
The answer would be zero. Nobody is going to work for nothing. These are called dynamic scoring. You got static scoring versus dynamic scoring. And the Trump administration and the Trump Treasury uses dynamic scoring to argue that these deficits are largely going to be subsumed by increased revenue generated through increased productivity created as a result of the tax cuts that are now permanent under the Tax Cuts and Jobs Act. That's the counter to that argument. It is a fact of life that when you reduce tax rates, you increase tax revenue. Every responsible economist will tell you that you don't increase tax revenue by increasing rates. You increase tax revenue by keeping the rates low and spreading the base. Unfortunately, the Tax Cuts and Jobs Act has taken more and more people, and this has been true now for the last 20 years. More and more people are coming off the tax rolls, right? Fewer and fewer people are paying taxes. That does create a problem as well. You got a lot of friction going on here, Josh. If you're hearing some contradictions, it's because there's a lot of different elements opposing one another, creating frictions in things that should be more simple.
So I'm going to try to simplify this if I can.
Good luck.
They're taking people off the tax rolls and lowering tax, but they're arguing because of dynamic models that somehow
the people that are paying taxes will be paying more revenue. They'll be keeping more of what they earn, but because they're earning more, they'll be paying in more. Instead of making $100,000 and paying 35% tax, they'll be making $140,000 and paying, 32% tax or whatever. The point is that the government ends up with more revenue. Milton Friedman observed this. There's no question. The Nobel Prize winning economist Milton Friedman, that most free market economists look to as a guiding post, it is a sentinel principle of economics that when you lower the tax rates, you increase tax revenue because those lower rates generate more income producing activity. I happen to have on my desk my copy. It's not a signed copy, unfortunately, of the essence of Friedman that's got all of these essential elements of economics.
So let me attempt number simplifying this. Again, there's two ways to raise revenue. One of them is spreading the base, and the other one is lowering the rate.
Lowering the rates will generate additional economic activity and generally increase revenue to the government.
Because they're making more money, so they're taxed on more money, but they also get to keep more money because they made more money. Because they're taxed on less money.
That's right. So, the perfect model, the sweet spot, is lowering the rates and spreading the base. If you do both of those things, you can lower the rates considerably by having a much broader base that encompasses virtually all income earners. Everybody's got skin in the game, Josh. And I think that's very important. That's another major principle of a sound tax system. If you don't have skin in the game, then you've got the right to vote for government benefits that you never have to pay for. You have the right to vote for largesse from the Treasury that somebody else has to foot the bill for, and you never have to be concerned about paying the piper. That is generationally unsound and economically unfair. Everybody's got to have some vested interest in keeping the cost of government down. If all we have are takers out of government welfare social programs, if all we have are takers and the pool of producers gets smaller and smaller, pretty soon you run out of like Margaret Thatcher said, pretty soon you run out of other people's money.
And that's probably going to happen sooner rather than later. This is a perfect opportunity for us to pitch our model of the consumer income tax or the consumer sales tax.
Yes.
Because that's really what it does. It spreads the base, but it also has the added effect of transparency so that the whole system is built into the tax system because everything is transparent. You see how much money you pay into the government. You see how much money the government gets based on how much commerce goes on in the country. The government has to be efficient with the money they have because they can't take from income earners.
You've got all kinds of benefits from a national retail sales tax system, from a consumption tax system that you don't have with an income tax system. Number one, you have stability. In the state of Minnesota, sales tax went into effect in about 1963 or 64. And you can count on just about one hand the number of times. You can count it on two hands for sure. The number of times that sales tax law has been changed over that period of time. Compare that with the number of times that the income tax has been changed in just the last 25 years. We talk about more than 6,000 times. And the reason for that, the reason for the stability in the consumption tax system is because it's so visible. Everybody knows what they're paying. When you go to the checkout counter and you have a $6 6% tax and you buy $100 worth of goods and services, another $6 is tacked onto the top of that. If next year you go to the checkout counter and you have to pay $9 or $12, you know exactly why those prices went up. It's because the government increased the sales tax amount, and can't blame it on inflation and blame it on big tobacco or big alcohol, automobile, or this or that, when the blame goes on big government. That's why the taxes go up. And people see that and they easily understand that. And so you got that stability because of the visibility and the point that it is spread wide. Because it's spread wide against all consumption goods and services, the rate can be held very low. Now you don't create the incentive for people to evade or avoid the tax, or all kinds of loopholes and structures in the code, give this person that break and that company this break, and you eliminate all of that stuff. The rate can be held very low, or as low as humanly possible, and then spread as wide as possible. Now, the opposite side of that coin is you got to control spending. It doesn't make any difference what kind of tax system we're talking about. There is no tax system that is going to be sufficient to raise revenue to fund a government that's spending 60 or 70% of national consumption. Now, we're not there yet, but every year that goes by, they spend more and more of your money as a percentage of income. It's out of control.
Is there anything else other than the rates that we should be aware of with this new bill?
Let's talk about the Social Security thing, because that got so much attention during the campaign. The president was going to eliminate all taxes on Social Security, and that did not come out of either the House bill or the Senate bill. What came out of both houses of Congress and is now passed into law is an additional $6,000 per taxpayer for any citizen 65 years of age or older. So if you're married filing jointly, you get an enhanced standard deduction of $12,000 on top of your already standard deduction. And if you're claiming itemized deductions and not using the standard deduction, you get the enhanced standard deduction in addition to that. So this is up to $12,000, $6,000 per individual for senior citizens age 65 or older, and that is going to help take the sting out of the taxability of Social Security. The problem with that, Josh, and now here again we get into these phase-ins and phase-outs.
He ran on no taxes on Social Security. He ran on no taxes on overtime. At the end of it, he was saying, let's just get rid of the income tax in its entirety. It was all bait and switch because he stirred the pot a little bit. Maybe
You blame Congress for that, no question. You blame the fact that Congress will not reduce spending. In these discussions, they'll say, if we eliminate taxes on Social Security, we're going to lose X $100 billion of revenue. All right. How are we going to pay for that? We have to raise taxes somewhere else to make up the X $100 billion of lost revenue. They never say to themselves,
the money's not yours, Congress. It's not your money. You don't have to pay for tax cuts. You don't have to pay for us to keep our money. That's not how this works.
It's such a distortion of the concept of paying for something. What never enters the discussion is, why don't we find $600 billion or whatever the number worth of frivolous, unnecessary spending, waste, fraud, duplication, whatever, just simply unnecessary spending. Let's find the $600 billion there. That never enters the discussion.
Because somebody's embezzling.
It's not a matter of embezzling. It's a matter of buying votes through the welfare state. That's what they're doing. 70% of the federal budget is transfer payments. We need to understand that as taxpayers and as students of the tax code and tax policy. About 70% of every dollar spent by the federal government represents a transfer payment, meaning they take money from people who produce it, run it through their elaborate Washington-based money laundering scheme, and pay it out to people who didn't produce it. They're not providing the essential functions of government. They're providing welfare benefits. They use these welfare benefits as sales pitches to get uninformed taxpayers who generally want to be off the tax rolls to vote for more of these programs that they never have to pay for. It's a vicious cycle that can only end in an economic collapse, frankly.
All right, well, that is a lovely topic to end the conversation on. But remember, there actually is no such thing as a hopeless tax case. So if you think yours is the exception, get a hold of Dan here. He will help you see the daylight. Dan, tell them where else they can follow along with your taxpayers' rights for sale.
Yeah, absolutely. Follow me. I'm at Pillow Talks Taxes. Pillow Talks Taxes. I'm primarily on TikTok, Facebook, True Social, and right here on YouTube. Make sure you subscribe, like, and share these videos, especially with your state and federal representatives. And if you have a tax tax problem. I don't care what kind of a tax problem it is. I've got more than 40 years of experience. Go to my website, TaxHelpOnline.com, and you buy any book off my website at any price point, and you get a free 15-minute consultation directly and personally with me. So go to TaxHelpOnline.com right now.